let's bring in Gene Munster, our fast money friend, founder of Loup Ventures. He's sitting here actually on this desk.
Nice to have you.
Yeah,
let's,
in the flesh.
We've got you for both of these stocks, but I want to start with Facebook since that's the last thing that we discussed. And I feel almost like investors are holding their breath for the conference call and what they're going to say about the OPEX guide, because that's always the bombshell.
That's the bombshell that's happened, I guess, 2 of the last 5 quarters, and so it makes sense to hold your breath for that. Ultimately, they laid some of the groundwork to expect expenses growing faster than revenue, so we'll get some context around guidance. I think that the probability that something is really off base during that earnings call is relatively low, just given at the core there's 2 real takeaways here. One is that the users aren't going anywhere. Impressive, over the last 5 quarters since Cambridge Analytica, they have continued to grow 8% year over year. And separately, this concept that advertisers don't have any place to go. I'm old, I'm 50, I don't use Instagram. I don't think that Facebook or Instagram are good for this world. But despite my beliefs, I think this stock is likely going higher.
So in terms of the advertisers being locked in terms of the users being locked in and really no movement on those 2 fronts, does that help or hurt Facebook in the face of regulatory concerns? And how should investors react to that? Because on the one hand, it's a very good thing from the investor standpoint. On the other hand, if it bolsters a regulator's case, then that could be a very bad thing.
Yeah, I think that Google is probably at the biggest risk when it comes to this regulation. I think Facebook has a much lower risk, but is probably number 2. And I think at the end of the day, it will elevate Facebook's risk, specifically how they have shifted people from Facebook to Instagram, using that connection point as a competitive advantage.
Gene, understanding there's dialogue to come in Facebook. With that said, if just the quarter, if that's all we heard, operating margins were 40.7%. I mean, that's as high as I think I remember seeing them. Free cash flow was $5.6 billion, much better than the street was looking for. I'm surprised the stock isn't significantly higher than it is now. Are you?
I'm not, just because analysts have been, we talked about what analysts have been doing with Apple. I think it's been an order of magnitude more bullish around Facebook over the last few weeks. And so I think expectations were excessively high going into this. And so I'm not surprised to see the stock only up a little bit here.
Okay. Well, we want to switch to Apple before we move on here. So, Gene, what was your take? And how do you think the stock is going to finish the after-hour session?
So this is almost a flawless quarter. They did have the hiccup around the Mac and the iPad, but overall, don't want to spend a ton of time on that. I want to shift to what the next, call it 4 to 8 quarters, are going to look like. And the comps get easier because of what we've experienced for the last few years. And then separately, they're going to get the iPhone 5G. The iPhone 5G cycle is likely going to be a couple years. So you can build a case that there's relatively clear sailing, as much as you can in a company like this, over the next 1 to 2 years. I mean, quite impressive. That's one takeaway. Second is we've talked about wearables and services. Put those 2 together, they account for 28% of the business, and they are likely growing at 25%. So this concept, and this gets to my third point about the stock, is essentially what's happened is they've taken a core product with the iPhone and they've built other products around it with services and wearables. And that other piece is becoming a really important part of the story. That, to me, is a consumer staple company. That's a company that should be, at a minimum, valued at something similar to Coca-Cola and to Procter & Gamble at a 25 multiple, which should yield a $350 stock. I was an analyst for a long time. I know the concerns and the fear that analysts have and why they only raise their price target a little bit ahead. And I think analysts need to look themselves in the mirror and say, think about this company over the next 2 years and think about them becoming a consumer staple company and properly rate it at a 25 multiple. I'm waiting for that analyst to come out and really put the stake in the ground, because I think that's ultimately what's going on. Well, you know what? I no longer work for an investment bank, but I definitely believe this should be a $350 stock. I don't want to say if it's the next year, year and a half, but I think it's going measurably higher.
I think that the baseline, though, for that argument is that Coca-Cola should be valued at 25 times.
Right. Now, maybe, yeah, fair.
And I think that there would be a lot of people who say it shouldn't be valued
at 25 times. Or Procter & Gamble.
So if you're going to make that parallel, there's also a dangerous side to that parallel, and that is if Coke is really worth, I don't know what.
18 times.
Maybe. 18, let's say?
No, but it's traded closer to 30.
Then, I think this concept of a consumer staple company, it's different than what's going on with Facebook or Google or some of the other tech, Amazon, some of the other tech giants. It's the only company that can tie it all together. The challenge is they're really expensive products and most of the world can't afford them. But that said is that they're actually tying everything together, and understand the concerns about that multiple, but I believe that Apple should, just investors and analysts need to rethink this and give it at least a fair multiple.